Good morning. Thank goodness it's Friday. Happy Friday, guys. Welcome to another morning live with Real Estate Mindset. I just wanted to say, first of all, let me start here. I can't believe I told you guys I woke up a little depressed the last time I did a live. So I want to let you guys know I have been wrecking my depression. I've already won this battle once before, so I had to remind myself that I'm 100% capable. And what I've been doing, guys, is when I wake up, first thing I'm doing, I'm hugging all of my children, remembering who and why I'm fighting. And then after that, I started working out. I've already burned 180 calories, 180 this morning. I suggest it. So if you guys are struggling right now, go outside and take a jog, do something like that, because I beat down that feeling of depression. Okay. So just want to let you guys know. But what we're going to do, you guys, is we're going to jump right into this report. Everything is going to be chaptered. This live is for you. So please ask your questions. I'll do the best I can to answer them. Just wanted to give a quick shout out to the first people that made it here on the live. Maverick, appreciate you. Dean, appreciate you as well. Good morning, sir. We got Jungle Book. Appreciate you as well, Jungle Book. That's a really cool dog. Got my buddy here, this guy. So we got a realtor in the house. I'm going to be calling on you, Adam. I'm going to be asking you guys some questions. So Adam, I already told you. I gave you a warning. Why is my picture? I gave you a warning that I expect you to do well, but good morning to you. P Nice, and there's my buddy. There's my man, Trey. Trey, beef jerky, brother. Ask Trey about the beef jerky. Trey knows about the beef jerky. Good morning, sir. Nice to see you. Nice to see everyone. We're going to jump right in, you guys. Oh, there's Volvo. There's Dean. There's all my buddies, Jungle. There's everyone. This dude, he is all over the place trying to give you guys reports on mortgage rates. So definitely appreciate that. Appreciate all you guys. I'm going to jump right in because people get mad at me if I don't start right away with the data. And I try to tell them, this is for you. I'm going to take my time. I want to engage with the community here. I want to answer your questions, but obviously I know I got to report, so we'll report. Now, let's start with the economic calendar so I can remind you guys what's going on. Also, I got the hustle sign in the background. Finally got the hustle sign back. My cat has been biting it. It has destroyed like 3 of them. So anyways, I got it back. Anyways, so wanted to show you guys basically what is left remaining, like what's the next stuff happening as far as the economic calendar. We got a lot of talking. There's going to be a lot of speaking from various Fed chairmen coming up here, or Fed governors. First one starting Friday. We also have Jerome Powell speaking on Sunday at 3:30. And now look at this, guys. It's just like this fest of people speaking and talking. I don't want to say lying to us, but they're probably on a lying campaign to keep interest rates elevated and calm down the market. But we have 3 speeches on Monday. We have also 3 speeches on Tuesday. On Wednesday, we have our existing home sales. The market's saying 4.19. My anticipation when I was talking to Jason last year was like 3.5, I think 3.5 to 3.75. I think I'm still standing by that. This is probably a seasonally adjusted 4.19. We'll also have the minute meetings here. Now, I am looking forward on Thursday. We're going to get new home sales data, another talk from Fed. Boom, boom, boom. And then we got consumer sentiment. But really, you guys, it's the data that I really want is the inventory and the prices of new homes. So that's coming. Let's move on to the 10-year. Now, right now, okay, so we've lost a decent amount of ground with the 10-year and mortgage rates. A decent amount. We're still good. We're still elevated, but we have lost a lot. We were much higher than this. We're sitting at 4.4. This is elevated today. Now, the day before yesterday, mortgage rates dropped under 7%. We're back over 7%. You guys have been watching me know that this thing right here tracks mortgage rates. So if you really want to know what's going on in the market, you don't have to listen to CNBC. You don't have to listen to your loan officer. Just track the 10-year. Track that 10-year treasury. You will be able to see the movements prior to rate pricing adjustments. So it's a really good way to do that. Now, let's move on to here, mortgage interest rates. Now, I want to ask you guys a question. Now, I'm going to look at the comments here. I'm going to make sure I still have the comment section working. It is. Now, I just wanted to, first of all, guys, let me go back here, okay? I'm going to go back on this screen, and then I'm going to go into the mortgage rates. But I wanted to ask you guys, I want to make sure you're getting this, okay? So generally, I'm going to ask you general questions, and I am not moving on until I can throw up the correct answer on the screen. So the first question is generally, what loan has the Caitlin, look at this. No, I know where you're going with that. Good man. No, what loan generally has the lowest interest rate? All right. What loan generally has the lowest interest rate? That was funny that you said pricing. That's funny. FHA, buddy. Good job, buddy. Where you at, Adam? Adam, where you at, man? So yes, that's right. So don't forget that, guys. I'm not saying that FHA is the best loan, but you have to at least acknowledge that FHA has lower rates, generally lower rates. And that's even than VA, Volvo. I'll show you this in a minute. Now they're very close. Look, I got a lot of VAs. Look at that. Adam, have you been listening? Oh my God. So, okay, here's the first thing. Generally, I said generally FHA is lower than even VA. Barely. They're basically neck and neck. But again, it's a little bit lower than, and a tiny little bit lower than VA. So it's FHA. A lot of people got that wrong. Now, and it's actually under a 15-year fixed as well. I'll show you guys that in a minute. Now, second question is, I want to make sure you guys get this right, okay? What is essentially, generally, what is the only advantage of conventional? What is generally sometimes the only advantage of conventional mortgages? Because remember, FHA, lower rate, right? That's it right there, okay? Wait. No, it's not. What is what is the answer here, you guys? What's generally the advantage of conventional other than, that's right. Okay, so I'm gonna go with this one. I'm gonna go with you, Volvo. Where's Adam at? So Volvo's pretty much right, but here's the thing: it does come with PMI. So generally, the advantage of conventional, like the one advantage, right? Like the one thing other than like sellers want it. So a lot of times, like sellers, like, oh, conventional versus FHA, I'll take the conventional offer because it's a stronger loan. But generally, as a consumer, what does it mean to you? You generally have the ability to have a lower mortgage insurance as long as you have more than the minimum down payment. So if you have a 10% down on a conventional, your mortgage insurance is going to be lower. Generally, depending on your FICO score, it's going to be lower than FHA. Now, also, guys, don't forget this. On conventional mortgages, if you put 20% down, you have no mortgage insurance. Now, if you only put 10% down, the lender will automatically remove the mortgage insurance at 78% LTV. You have a legal right to call in or write into the lender to request your mortgage insurance be canceled at 20% LTV. Now, on FHA, remember this, it does not matter. On FHA, even if you have a 20% down payment, you still have a mortgage insurance premium, okay? The only way to have mortgage insurance removed from FHA, two things, okay? It's not one, it's two things. You have to have 10% down or more. And then there's a but, okay? This is what kills it. Plus, so 10% down or more, plus 11 years has to go by. Okay, and that's why I'm saying conventional, yeah, you can get rid of mortgage insurance. FHA, I mean, not a lot of people are going to hold, especially at today's rates, for 11 years to avoid mortgage insurance, right? So just hear me out there. Now, last question, then we're going to get started, okay? How do you reduce debt to income ratio? There's two ways. How do you reduce debt to income ratio? Remember, guys, debt to income ratio is like the gauge on your ability to afford a house. There's two ways to drop your debt to income ratio generally. So generally two ways. How do you drop your DTI? And remember, that's your purchasing power. So how we increase, no. Well, I mean, yeah, you could say stop drinking. Yes, but no, I mean, come on, man. Yeah, there's one. I want two. There's one way. So one way, there it is right there. You guys got it. Good job. Okay, so here, boom. So you got the full answer, Kayleen, this time. Good job. So you got two ways to do that. And virtually only two ways to increase your purchasing power. Number one, you increase your income. But number two, you reduce or lower your debt. Okay. And I'm not talking necessarily about the total debt balance. What I am talking about is the monthly payments, because it's the monthly payments that count against your debt to income ratio. So it's not really the balance that matters. It matters to you and I, but from a qualifying standpoint, they're only calculating monthly payments. So your balance is moot for the most part. Anyways, guys, here's the mortgage rates right here. And this is what I'm saying. So okay, it actually flipped right here. But here's let me get this comment out of here real quick. There's Johnny. Johnny, where's your I can't wait to get to Johnny here in a minute. But here's today's mortgage rates, you guys. And I definitely forgot to put my timestamp on. So I'm going to do that now. Now, here's my point. Here's 30-year. Here's 30-year FHA. So FHA is at 6.55. And this is my point. Now, sometimes this flips, but generally FHA is lower than even VA. VA is basically the same. It's only 2 basis points higher. But now FHA is a lot of times lower than conventional 15-year. But today, A 15-year mortgage is slightly lower than FHA. So just look at FHA as like a 15-year, like you get a low rate, like a 15-year mortgage, whereas conventional 7.02. So conventional is generally 50 basis points or 0.5% higher than your FHA. Now, as a consumer, if you have like more than 5% down, generally you're going to just always want conventional, generally. But if you're only doing a minimum down payment, okay, if you're only doing a minimum down payment, generally FHA is cheaper. Generally, it's cheaper. I mean, I don't know how else to say it. I'm not saying everyone should get FHA. What I'm saying, weigh your options. All right, weigh your options. Now, let's just real quick. Good job, you guys, on those questions, by the way. Now, let me go real quick. I just want to emphasize how bad amortization schedules are. Remember, if you decide to refinance, you start your amortization schedule all over. One of the keys to refinancing would be to also shorten the term. So if I have a 30-year mortgage and I've been paying for 3 years, it's then a 27-year mortgage. If I refinance and get another 30-year loan, I start the clock over again. So a key would be for me to not only refinance into a lower rate, but also to reduce my amortization schedule, say to a 20-year loan. So if you can afford to do that, then in that way, it's a lot cheaper to refinance. Now, the reason why it's so expensive to refinance is what you're looking at on the screen, this amortization schedule. I put today's rate of 7.02% with an average loan amount of $324,000. So your average loan amount of $324,000, you're going to pay in just fees $453,000. I don't want you to pay that. You don't have to pay that. You only have to pay that if you don't listen to me. You only have to pay that if you're just going to stay in the rat race, if you're just going to stay following what society does, then you're going to pay that. But you don't have to pay that, guys. All you have to do is you put a little bit of money extra towards your principal. I'm telling you guys this all the time. In fact, if you guys paid this down $19,000, you would save each column of interest here. Now, this is a yearly breakdown of your interest and your principal. Year one, you pay $22,000 in interest and only $3,200 in principal. The 29th year, you pay only $2,600 in interest, but you pay a whopping $23,000 in principal because it's front loaded. So all you guys do, and this is my strategy as well, put about $15,000, $20,000 to your principal when you can afford to do it, when you're not maxing yourself out, and you guys will crush that amortization schedule. And in fact, you don't, and I'm going to get you guys questions after I do the video, so keep commenting, but you don't necessarily need to do that. You can also make monthly payments. Give me a monthly payment to put in here. One time we did $500. One time we did $10,000. Comment, first person that comments a dollar amount, I'm going to put into here, but I'm going to, okay, there we go. Okay, so only 150. Okay, so who can't, a lot of people, especially if you purchased prior to 2022 and you have a super low interest rate, a lot of people should be able to afford $150 extra. So let's see the power of $150 extra towards your principal. Remember, it must go towards your principal. You must say to the lender, I want to pay $150 towards my principal. Sometimes, not all the times, but sometimes they do a little tricky business and they just take the extra payment and they put it in your escrow account. Okay, you don't want it in your escrow account. They'll just refund that money to you at the end of the year. You want the money to specifically go towards that principal. So make sure to say that. Let's calculate what $150 does. Okay, so $150 extra a month turns a 30-year loan into a 24-year, 7-month loan. And you guys paying only $150 extra a month, you save $97,000 in interest. Oh my God. Oh my God, right? I mean, that's a lot of money in interest. That is a ton. So in other words, don't be like most people. Don't be like most people, all right? Be strong. Understand how these things work so it's easier for you to get ahead, all right? Now, remember, okay, I've been preaching about this a long time. What matters is as a consumer, okay, I'm going to show you guys what the pros. Yeah, right. But I'm going to show you guys what the pros are looking at behind the scenes as it pertains to this horrible fluctuation of mortgage rates. Now, obviously, Kayleen got that right. But, instead of saying mortgage rates are changing every day, what we should be saying is the pricing of the rates changes every single day. Remember, it's the pricing. And as a consumer, if you understand how pricing works, you're going to be able to shop your mortgage better. Remember, the way that inquiries work on credit. First of all, if you go run your credit with a mortgage company, your score will probably drop 5 to 8 points. But remember, there's also a grace period with the inquiry. So it's designed to allow you as a consumer to shop your mortgage. So only the first inquiry will hit you. I believe it used to be for 30 days. I've heard rumors it's only 2 weeks now. But my point is there is a grace period. So you should be shopping, but understand what you're shopping for. And this is what I mean. If I'm shopping someone and I go to a broker and they say, I can get you a 4.5%, for par, but I go to another lender and they say, oh, I can beat that. I can get you a 4.35%. But if you don't understand that it costs 2 points to get the 4.375%, you may be getting a much worse deal, even though the rate is lower. Even though the rate is lower, you may be getting a worse deal because of this, the pricing. Okay, so remember how this works, you guys. Now, let's look at this right here, the 6.375. Okay, so today it's saying that a 6.375 is the closest interest rate to what's called par. Okay, and par is basically a free rate that doesn't cost you money and that you don't get money. And now that's the closest. So if I take right now a 6.375, the pricing for that is a rebate of $713. This means that the lender, the bank, the servicer, whoever I lock with, probably through Optimal Blue, is going to give me $713. Now, if this is hypothetical, okay? But if I'm struggling to meet my closing cost, if I take it, and I'm not saying to do this, I'm saying you have the option. If I take a 6.12, I apologize, guys. This is actually a cost. Dang it, I apologize. That's a cost right there. Now, and I'm gonna reverse this, okay? So if I want a lower interest rate, is what I meant to say. I apologize, guys. If I want, I guess I wasn't working out long enough this morning. But if I want a lower interest rate to help me with my payment, is what I was trying to say. Lower interest rate to lower my payment, it will cost me to get a 6.125. It will cost me $5,700. Now, how do you justify paying $5,700 to buy an interest rate down from 6.3 to 6.1? Well, the way you would justify paying down an interest rate is if the dollar amount of your monthly payment drops enough to warrant that investment. Now, with so many people expecting to refinance, right, with elevated interest rates, I really try to shy around from recommending people buy a rate down, especially if your intention is to refinance. But if you did, again, what you weigh the payment at the higher rate compared to the payment at the lower rate. And the difference in payment is about $90. Okay. So if I pay $5,700, I save $90 a month. Generally, how I calculate that is if I can yield back the savings after 5 years, it might be a good idea. It's something that I would consider. In this environment, I don't know that 5-year rule is practical. Again, because we have such a chaotic dynamic right now going on with pricing and mortgage rates and things like that. But that's basically how that works. Now the same thing, back to what I was saying before, if I'm struggling with my closing costs, hypothetically, if I take a 6.625, okay, a higher interest rate, if I decide to take a higher interest rate, that would increase my payment about $95. So I increase my payment now $95. The bank pays me, okay, they pay me now $3,500. So on one hand, I'm taking the higher rate, the bank is paying me. On the other hand, I'm taking the lower rate and I'm paying the bank. But to be honest with you guys, it's all paying the bank anyways. That's why the Federal Reserve exists. The Federal Reserve exists to protect the banks, not the consumer. Just my opinion, although I get it, right? Credit restricting. Oh, if the Fed wasn't there, then it would be harder to get credit, blah, 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 right? I get it. But still, I don't care. The bank term funding program, I thought was a complete disaster. We're going to go into our first video, you guys. And this is a good video. Actually, let me set this up. Actually, you know what? Let me show you this real quick before I do that. Let me show you guys one more thing, okay? Back to the mortgage report. Here's a 5-year break-even inflation. This is basically the market anticipating how long it's going to take or what inflation is going to be in 5 years. So remember, the inflation goal is 2%. The market is saying in 5 years is going to be 2.3. So the market is saying in 5 years, they're still not going to hit their 2% in 5 years. That's what the market, I mean, you guys see this? This is the market expectations. We also see expectations here, which is CME Fed Watch. Now I go to December. I don't even care about this is so off that I'm ashamed I even mentioned this. But nevertheless, you guys, the market is now pricing in 2/4 basis point rate cuts. When? I don't know. Who cares? The market's always wrong. But nevertheless, you guys, they're still pricing in that too. And that's what you see here. This column represents 2 rate cuts, 37% chance. But this column represents 1 rate cut, again, 1/4 basis point, 31% chance. Market saying 9.1% chance, a no rate cut. Okay. Now, I'm gonna go back here real quick. Now we're gonna jump into our video, and then I'm gonna take some questions. So definitely comment. First video, you guys, is from the Richmond, this guy right here, from the Richmond Fed Reserve. Okay, and it's very interesting. He's going to be talking about inflation and how businesses can no longer pass the expense on to consumers. So it's a very interesting video, actually, that he's actually analyzing the fact, like, hey, if you're a store owner or you're a business, good luck passing higher prices onto your consumer, because consumers are starting to stop spending. The spending is slowing down. So I thought that was a good video. Let me know if the audio is good, you guys. I definitely appreciate you and enjoy.
Steve Leisman's here at Post 9 with a very special guest, Steve.
Thank you, Carl. We have Tom Barkin here from the Richmond Fed, just a short hop up from Richmond to New York. Thanks for coming, Tom.
No, great to be here.
I want to start with you in a place I don't start with most Fed officials, which is because you come more from the business world,
right,
rather than the economic and theoretical world. And you've been talking for many years now about what I call the culture of inflation. Your whole idea was it became okay in the middle of the pandemic to raise prices. And you've been watching this tension between the companies, the sellers, and the buyers. Where are we at, in your opinion, in the ability of companies to pass along higher prices, whether or not it's still cool to do that, and whether or not consumers are fighting back?
Well, if you go back to before the pandemic,
right,
people really thought, as you said, they had no chance. They'd been
no
schooled
pricing
by
power,
e-commerce and globalization and market power and all of those things to say, I have no chance. Then the pandemic hit and they really had no choice. And so people took a step they just hadn't been ready to take, which is to increase prices. And when they took them up, they didn't find any consequences. There were no consequences.
What about the deficit spending?
We'd like to think we're back in the no chance world again, but people are still saying there's no crime in trying. And they're still trying. Now, I think there's a big difference between goods and services. And when I talk to folks on the goods side, and you can see this in the numbers, I think goods producers are sort of convinced at this point that they're back to where they were. They're hearing very aggressive news from the intermediaries like the Home Depots and Lowe's of the world that says we don't want to take any more price increases. The commodity costs have come down in many cases, and so they don't have the story anymore. But on the services side, I'm still hearing people trying. I was with a pest control company last week who said, oh, no, we didn't take prices up for 7 years, from 2015 or 2013 to 2020. Then we took it up a bunch. We're still taking it up. And labor is a story that they use, so it has something to do with cost. But it also has something to do with they've changed their view on price elasticity on the customer side. Those aren't the words they use, but that's what they've changed their view on elasticity. And they're going to keep trying until customers or competitors.
And we're not there yet, in your opinion?
Not on the services side, but I think we're getting pretty close on the good side.
Which brings me rather easily to the inflation report yesterday. I don't know. I guess in economics, you get more than 3 strikes because it was 1, 2, 3 strikes and you're out through March. Mm-hmm. Yesterday, did you see that as a little better? Are we back on track, as Mike Santoli suggested?
Well, I actually was even more interested in the retail sales report yesterday because the consumer spending numbers for the couple of months before that had come in quite strong and stronger than I was hearing in the marketplace. So I was testing my own thinking on consumer spending. I think when you take the retail sales of yesterday and you look at the 3-month numbers, you now say, okay, that's what I'm hearing in the marketplace, which is good but not great consumer spending. So that was one piece of the puzzle, which is how hot is demand. On the inflation side, it certainly came off the numbers of the prior few months, which was good. It's still not where we're trying to get in target. And most importantly, I'd say back to where I was going, goods, 0 to deflationary, services and shelter still inflationary. And you'd like to imagine that mix would come back more toward where it was before COVID.
I know my colleagues are anxious to ask some questions here, but I want to do one more before I before I give it up here. Is it your opinion that the consumer and growth needs to slow to get back to your 2% inflation target, or can we do it with GDP remaining above trend and potential?
Well, we had a really good year last year. Supply chain stuff was unbelievably helpful.
And you didn't need to run below potential. But you didn't need to run below potential.
Exactly. And you could always come up with some more supply stories, some supply side stories that would help you. But I do think we're going to have to take the edge off demand. Not we, but the edge we're going to have to come off demand a little bit more to have inflation back at target. But we'll see. That's when I say that customers and competitors are going to need to teach people that they don't have pricing power. That's what I'm
yesterday.
Interesting. What do you guys think of that? Very interesting. Very, very interesting. Now, the economy did great in 2023. He says, well, what's up with the deficit spending then? Then why did they need so much deficit spending? Almost $2 trillion in deficit spending. Why do they need that if the economy was so great? Why pump so many government jobs into the economy if it's great? I mean, seriously, what do you guys think? All right, let me pull up some comments here, and my microphone is right in front of my face, so I have to kind of lean down here. So we got one comment here from Wake Dog. Corporations buying single-family homes should be off limits. Let me know whether or not you agree with that, guys. It's so much controversy. People get so upset when I say, cap the institutional cap the investing, because no more government involvement. But it's a really difficult situation, guys, because it's the less of which one is the less of two evils? Because if without the regulation, that greed, the corruption, the fraud, the collapse, all that stuff is going to happen every single time. But when the government gets involved, it's a Keynesian injection of liquidity, right? And that's why a lot of people think that this is the new normal, the government bailing us out. I personally, Wake Dog, I agree with you. I think corporations should not be buying single family homes. And they said single family homes, you guys. We're not talking about apartments, 5 units, not talking about any of that, but an SFR. And I 100% agree. Let me know what you guys think. Now that they were teasing us with some type of legislation they were going to pass that got institutional investors out of the housing market, and we haven't really heard too much more about that. This is a good comment that I wanted to talk about because of all the sub-2 scammers out there. Now, what they're saying, Sonny, is Sonny's saying FHA and VA assumable loans at a low interest rate can be taken by anyone. So that's not true, Sonny. It cannot be taken by anyone, but FHA and VA has the ability to approve. That's the key word, Sonny. Approve. So FHA and VA has the ability to approve somebody, a buyer, to assume that mortgage legally, the right way. So actually, I don't think that's a bad thing. If you guys can find a property, if someone's soliciting an FHA or VA and it's like a 2 or 3, 4% rate, maybe you want to talk to that seller and talk about how to go about the approval process to assume their loan. All right. Next thing from Dean here. There's a spending culture that's out of control. My date yesterday said how when she sees others with something on Instagram, she needs to buy it. And that's one of the issues. I appreciate you putting that up here, Dean. No knock to your girlfriend, but we don't have to be like that. That's what I'm saying, guys. And in fact, there's so much bad purchasing out there that generally it's easy to be successful in real estate. If there wasn't so many people purchasing real estate recklessly, it would be hard to make money in real estate. But because so many people are recklessly buying real estate, we get the opportunity. You guys, there's a massive spending habit in America right now, and you don't have to be part of it. You could take a break. You don't have to be part of that rat race, but you have to put an effort in. You have to stop yourself right now, probably from your spending habits. I'm not trying to judge everyone, but there's definitely a percentage of people that are watching right now that should probably stop what they're doing and change their spending habits. Access your bank statements. See exactly line by line what you're spending on. You guys, your bank statement has your spending habits. I can do almost all of my taxes based on just bank statements because the money comes in and the money goes out to the same bank account. So please, and then some bank statements and bank accounts actually categorize your expenses, but you guys don't have to be like those people. I hope that I hope that's why you're watching. I hope you guys are watching for that reason. Okay. Really, really appreciate you guys. Let's see here. Oh my gosh. Jeff is here. What's up, Jeff? It's nice to see you, brother. Definitely nice to see you, Jeff. So I'm going to go into the real estate part and I'm going to show you guys this again right here, which is a subdivision analysis form. So I'll do that again with you guys. But a couple things I want to go over, if I may. So we're going to go into our real estate section. Before I forget, I will put a timestamp here right now. Okay. So take a look at this first of all. Let's go into asking rent. Whoops. All right, let's go into asking rent. So this just came out today, this morning, you guys, and this is going into rent. Now, rent inflation has been a huge problem. When we compare buying to renting right now, it's way cheaper to rent. But if you're a homeowner that purchased prior to 2022, rent is actually probably more than your mortgage. Understand that. So it just depends where you're at in the cycle. Are you a homeowner? When did you buy? Because if you bought 2022 and on, probably rent is a lot cheaper. Okay. But again, prior to those golden handcuff homeowners, honestly, rent's probably more money. It's crazy if you think about that. But regardless, you guys, the Sun Belt is seeing some of the biggest rent declines in America. That's interesting. 9 of the 10 metro areas facing the steepest drops in asking rent are in the Sun Belt. The exception is Seattle, where rents fell 7% year over year. 7% year over year. Now, instead of reading this and looking at the chapter, so I'm just going to go down to this chart. I'll have this linked in here if you guys want to check this out. But take a look at the biggest losers and some of the biggest winners. Okay, so look at this column here. This is the year over year. This is month over month on the left. But again, look at the right side for now. If you want to see the top year over year, Seattle is winning. Is that because of the crime? What is that? Did it fund the police? Is that all kind of catching up now? But Seattle, because there's, people don't want to live where, criminals are running things. Would you guys agree with that? Don't you want to be safe where you're living? And I won't go into some rant. I want to, but I'm not. But regardless, Seattle is down year over year, 7.3%. Who lives in Seattle again? Never mind. Oh, actually, he doesn't live in Seattle. I won't talk smack, Johnny. Austin's number two. Austin's number two at 6.6%. And this is really, we don't even see the Tesla layoffs in this info yet. This is all so lagging. It's all lagging, you guys. But Austin's down 6.6%. Nashville down, Trey? Well, not really Nashville, but 5.9%. Number 4 is actually a Florida metro. Jacksonville is number 4 at a drop of 5.6%. Miami? Are you kidding me? Miami's the number 5 metro area right now with rent decline, year over year rent decline. This is asking rent. Okay. So this is not actual like the end of leases. Like what did people commit? This is the asking rent. So if I go to rent, it should be this much lower than last year. So this is like if I go to rent, you guys know what I mean? But anyways, Miami, and look at, this is crazy. House Hacker. Okay. House Hackers from San Diego. San Diego's the 6th top metro area with the largest rent asking rent decline. I'm sorry, you guys are getting tongue twisted here. 5.7%. Phoenix as well. That's insane. 4.6 from Phoenix. Charlotte, I toured Charlotte, 4.5. Another Tampa, Florida, Orlando, Florida at 4.3 and 3.2. But let me show you guys the top. Okay. So the number one, like leading, like rent, like this is bad. Shelter inflation is still going up. Minneapolis, look at that. 10.3% increase. Ohio is getting slammed. Ohio and Chicago are getting slammed. Chicago's number 2, highest growth at 9.9% growth year over year. Number 3, Chicago. See, Chicago's getting slammed in the rental market. Growth of 9.1%. New York as well. Number 4 at 8.9. Washington, D.C. at 8.6. In other words, you guys, there is a huge division in the housing market. And because there's such a division, I think it's kind of important to remember where we came from. All right. So let's just look at inventory. We're going to go over inventory real quick. Now, here's what I want you guys to understand on inventory. Okay. Let me just highlight 2017 real quick. Change that to green. So this is demonstrating. Let me see if I can zoom in for you guys. I don't remember where the zoom in button is here. Anyways, I'll read this to you guys unless I can zoom in right here. Let's go to 200%. Okay, that's a little better. Okay, here's the green line. Okay, good. That's a little better. Now, first of all, in 2017, 2 years before the lockdowns, right? At least 2 years before the lockdowns, we only had 3.9 months of supply. Where's this 5 million? You guys keep hearing, we need 6 million, 5 million houses. When is that? We've never had that. I keep telling people. In 2017, we only had 3.9 months. That's it. And for listings, this includes active and pending. Remember, you guys, I've really only been talking to you guys about active, like what's our options right now. But this is active plus pending. So in 2017, all we had for inventory, active plus pending, was 1.46 million. That's it. That's all we had. And if we go back to 2012. Okay, this is going back to 2012. Here's 2011. So 2011 is the first time in the last, 13 years that we had over 6 months of inventory. Did y'all know that? In fact, if you look here, we've only had, if we look at just the last 10 years, of those 10 years, okay, I mean, there's let's see, 1, 2, 3, 4 years that had over 3 months of inventory. Did y'all know that? Did y'all know that? In fact, in 2019, we also only had 3.9 months of inventory. 2018, we had 4 months of inventory. So what I'm trying to paint the picture here is be careful what you're listening to. We definitely have in some markets a shortage of inventory, okay? But in every market, we have a shortage of affordable inventory. But that could change very, very quickly. I want to show you guys where we're at right now. So again, remember, we're at before COVID, and in 2017, you guys remember the numbers. Let me throw it up one more time so you guys can see. All right, so just remember in 2017, okay, apologize guys, right here. Okay, it's not working right here. Okay, so in 2017, we had 1.46 active and pending, okay? It's 2017. Now, take a look at what we're at right now, which it is lagging. Okay, look at this. So right now, as of March, we're at 1.1 million. So this whole time, I've been pretty much saying we need, 2 to 300,000 more units. And here's the but, sustained. If it's not sustained, it doesn't matter that much. We need it sustained. Thank goodness we have elevated interest rates, because it is sustaining the inventory, because it is lowering purchasing power. It is lowering the demand. That's what the rates are doing. But also the price is doing that. So you have the rates and you have the price. They're both doing that. Now, it's not going to take long, guys. Okay, that's all I'm saying. Just be patient. Now, what I'm going to do is let's go through I'm going to show you guys again what a crash looks like. So I have set up, okay, let me show you guys. I have set up my MLS. Okay, what you're looking at here is I have filtered, I don't know, 20,000 listings, and I have put crash-like parameters. Okay, so I have crash-like parameters, which is basically $100 to $120 a square foot. So my parameters are, the size of the house and the price per square foot. And if you look here, there's barely any listings. Okay, comparatively, if I take off the filters, you're going to see listings everywhere. Now, remember, you guys, these are crash-like prices. So what you see there essentially are crash-like prices. I put my filter on my MLS. But when the housing market crashes, and I want you guys to understand what I'm saying, because I don't want you to get stuck on the sideline renting. In a crash scenario, all that's going to happen, well, first of all, you're going to have credit tightening. You're going to probably have lower interest rates as well. But all that's going to happen from a purchasing standpoint, like inventory, is you're going to see more of these dots. You're going to see these dots everywhere. That's the only difference from that standpoint. And so I want you guys to understand, if you are on the sideline, learn how to find that great deal. So again, if I wanted to say, let's investigate this house. Okay. So I'm like, yeah, this house looks good. This is the one I want, blah, 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 blah. Right. Then what I'm going to do is I'm going to do what? What am I going to do? I'm going to do this. A subdivision analysis form that I have created for you using simple math. All that you guys really need to do that's a little bit hard is you need this info and you need this info, the price per square foot. That's really all you need. If you can get that info, you can do this form. All right. But I'm going to complete this form. I'm going to complete it. Okay. So this is the house that I want to buy. Okay. Hypothetically. Oh my gosh. It had a price cut too. Look at this. You guys see what I'm saying? You can't say that prices are going up everywhere. There's no blanket statements because this price is only $101 a square foot. Oh my God. Let's see. And they had recently had a price cut 2 days ago. So they cut the price it's already under market. They still can't sell it. So they cut it another $10,000 because they're getting desperate. So the important thing, and I'm going to write this on the top here, is you got to figure out the subdivision. Remember, you guys, the subdivision is like the neighborhood. Okay, so we're going to do a neighborhood, right? Neighborhood analysis, again, just called subdivision. Some places don't have subdivisions. In that case, you're just going to want to do a radius and look at comps. But the name of this subdivision is Elk Grove Village. Okay, so I'm going to copy that. But remember, I do need some characteristics on the property. The first one being the purchase price. So the purchase price is listed at $230,000. I also want the square footage. The square footage is 2,000 I have no idea what these numbers are going to show, by the way. 2,273. And remember, you guys, we want the property taxes so we can calculate our cash flow and calculate our mortgage payment. Oh my gosh, the taxes are brutal. Dang, on that house, the taxes are, that's crazy. This is a huge problem. All right, so here's what I learned. Okay, so first of all, the taxes, is this right? Let me look at this again. Holy crap. So the property taxes on a 200, this is why it's not selling. This is why it's not selling. The property taxes on only a $230,000 house, $7,100 a year. Holy crap. That's crazy. That's crazy. All right, let's go back into it. Okay. Now that I have this information, this is what I filled out. Okay. I filled out the subdivision called Elk Grove. Okay. We got that, right? Pretty easy stuff. I put the purchase price, 230,000. I put the square footage, 2,273. And then I put the property taxes on that tax line right there so I can calculate. Okay. Now let's reverse this. I'm going to go like this. Okay. Now I'm back into my MLS. And I'm just going to only review subdivision, which is the Elm Grove Village. Okay. And I'm only going to look at sold properties in the last year. If I was serious about this property, I would go 4 years back and look at the patterns. But just for the sake of the video, I'm going to go a year back. Okay. So let's just go 365 days back. Elm Grove Village. It shows me, wow. This is going to be a good one. It shows me 80 homes have sold in the subdivision over the last year. Okay, so remember, I want a variance of 500 feet. So if my property is 2,200 square feet, that means I want to remove any property that is 1,700 square feet or less. Okay, so on this first page, first of all, I'm going to select everything. But again, I only want comps that are in a variance of 500 square feet up or down. So I'm removing all of these comps because they're too small. It's not, you want to have comps that are basic size of the subject property, or you're not going to get true reading. So I'm removing all of the smaller houses. See? Okay, boom, removing. Geez Louise. Okay, let's go to the last page and remove. Okay, so all we have to remove is okay, so we're only going to select that one. Let me go to page 3. Let's select these. Okay, boom. Select these because these are all within size range. Okay, so now I have 53 comps of the 80. So I have filtered this down from, again, 80 to 53 comps that are closer similarity to the subject property. So now I'm going to organize this and basically just add and divide. And this is going to tell me, okay, here's active up here. Here's the sold right here. So as far as sold properties, look at, here's my price per square foot. This gave me multiple things because I had active included in there and I shouldn't have, but it does remove it right here. That's why you guys see 3 categories. But regardless, the sold property, the comp data is what we want. That's interesting that dropped. So we have a very valuable piece of information because now we know that the average home sold in that neighborhood at $128 a square foot. All right, so now I have $128 a square foot. Let me go back here and I would do the same thing for the rental market because I want to be able to cash flow. I'm going to do this very quickly. I'm just going to throw in the subdivision here, pop like that. I'm only going to go for the last year again. Okay. And then I'm going to hit results. This is the rental market now. Darn it, I had active in there. I'm just going to select everything right now. Again, I would do the variance of 500 square feet, but we're running out of time, so I'm not going to do that in this specific breakdown. And look at that. That's really good. So this is saying, wow, that's really good. That neighborhood's really good. $1.12 a square foot for rent. Okay, this is what we have. That's what we have right there. You guys see that? So that's where we're at right now. Now, what I want to do is I want to calculate my mortgage payment. Okay, so I'm going to go to Google and I'm going to put in a mortgage payment right here. Okay. And let's start putting in the information that we have. So I'm going to check this here. I'm going to put my listing price of $230,000. Let's say I'm only going to put 5% down. Okay. Remember, I'm shopping the broker. I have good credit, so I am not going to get this rate. I have good credit. I'm going to get a better rate, so I'm going to use 7%. Okay. Remember, I have my property taxes. This property is way overtaxed. I'm going to put my property taxes in there. I'm going to increase my homeowner's insurance because ain't no way it's only $800. It's going to be more like, let's say $1,700. All right. So I've calculated an estimated payment right here. So I'm going to put that on this form. Okay, right here. And this is what we have. Now I have enough information to calculate my wedge and my cash flow. And I have gross there. I have gross there because remember, there's additional expenses you have to take out. So let's first calculate the wedge. All I'm going to do to calculate my wedge is I'm going to multiply the size of the property by the average price per square foot. That's all I'm doing. This is very, very simple math. So I'm going to make that multiplication right now times 128. That means the market, okay, the market is saying my home is valued at 290. I'm just going to write this down here. And also, guys, I put the formula right here. Okay, so now that I have the 290, I'm going to subtract 230,000. That's crazy. And I'm going to get my gross wedge of $60,000. And a lot of people are still asking me, like, Travis, what's wedge? That means I have equity moving into the house. That means when I close on that house, I have $60,000 of cushion. If my home goes down $60,000 in value, I'm not upside down. That's what wedge is. The higher the wedge, the safer you are. Now, if it's an emergency and you guys have to sell, how do you sell and not, I mean, how could you sell if you're upside down? Well, you can't. So in an emergency, maybe you want to rent out your property. So all we're going to do to figure out gross cash flows, we're going to multiply the size now by the price per square foot to rent. That's it. So let me go 2,273. This is a good house. This is actually a really good one. Times $1.12 a square foot. That gives me gross rent, okay, of $2,545. All right, now what I do is I subtract these two, and I'm going to get my cash flow of 2,338. Boom, look at that, $207. Finally, I found a property for you guys that has both cash flow and wedge. But you guys see, like, if I do that, what I just showed you, I'm putting myself in a safer situation because, again, if I have to leave for whatever reason and I can't sell because I'm upside down, at least I can rent it and I can get $200 a month. I'm not going to necessarily go broke, hypothetically. And also, if property values go down, I still have $60,000 in wedge, so I can sell my property under market for about 30, right? That's why we do things like that. Now, in this market, with so many changes going on and a collapse around the corner every other day, wedge and cash flow may not be enough, but at least it gives you a leg up on getting through a potential hardship. Okay, that's the only point I was trying to make there. Now, let's go into the next thing. I hope you guys like that. It's so hard for me to just like stay on point and draw these things and like stay focused. So now we're going to go into our next video. That's going to go and talk about shelter inflation. Okay, so we're going to be talking about shelter inflation and how that potentially is it changing. Remember, I just showed you several metro areas that had a decline. Okay, let's see what this guy has to say about shelter inflation.
Right off the bat, about the state of the residential housing market in America. Is there any relief in sight for people who are looking to find some kind of rent stabilization in the coming months and years?
Well, thanks, Tom. There is absolutely. So when you think about single family and multifamily rentals, it's been a very, very strong market. There's no question about it. But rents are coming down across the country. We had the massive pandemic demand push that happened in 2021, 2022. That backed off a bit in 2023 and 2024. But what the real story is supply. So supply is at 40-year highs right now. And the interesting thing is that a lot of people thought the rental market would collapse. And for good news for our company and other multifamily companies is that the market hasn't collapsed, but it has slowed. I mean, rents were up 13% in 2022. They're up 3% in 2023. And now we're seeing 1.5% growth in 2024. Now that's a significant slowdown. So it's helpful for renters, but also it's helpful for the Fed and the CPI. That CPI number is backward looking probably at least 8 or 9 months. So the good news is the CPI will continue to fall in terms from a rental perspective because the market is slowing, but it's not collapsing, which is really a positive thing for these stocks and for companies like Camden.
Rick, is it safe to say then that with the housing market the way that it is right now, with interest rates kind of moving the way that they have been ever since the great financial crisis, and now with the housing dynamic, that there's a secular trend towards renting for Americans versus owning?
Absolutely. So the challenge you have today in the single family owning market is that we're at a really big change in terms of what it would cost to own a home because of the doubling of interest rates, obviously. And so what's happening is that it is a lot cheaper to rent, like 60% less to rent an apartment than buy a house today because of high interest rates. Now that will change over time as interest rates come down, but it is a really good time to rent. And from an affordability perspective, when people are getting pinched on their budgets, and it's cheaper to rent than own a home. As a matter of fact, today,
You guys, I want to make a quick point. I think it's a good time to make that point. Remember, a lot of the golden handcuff homeowners, it is not cheaper for them to rent. And again, that I believe that's one of the primary reasons why we don't see excess inventory for existing homes. Remember that if those homeowners did a cash out refinance and traded their low interest rate for a high interest rate, then yes, then it's a different situation. Now, the best comparison I can make to that is generally the people that were purchasing in 2022 are like GFC homeowners that don't have any equity, that are struggling to afford their payment from a DTI standpoint. So remember that, you guys, there is a huge division in ownership. A lot of realtors, what they do is, and I'm not saying you, Adam, but a lot of realtors are talking as if the housing market is still 2020. It is not 2020. The housing market right now, we don't have massive equity growth. We don't have PE ratios super low. We don't have 2% interest rates. We have a very, very toxic housing market. So understand those two dynamics, guys. Very, very important. And I'm going to get to the comments here in a second. Some really good comments that I'll address, but let's go back to the video.
Our rent to income is at one of the lowest percentages. We're at about 19% of people's income to pay rent, which is very low. Usually it's in the low 20s. So it's a very affordable product today relative to single family homes.
Interest rates also play a factor, not just in how rents are charged and how much people pay in mortgage interest and mortgage payments. It also affects financing for building properties, which is what you do. How are those rates affecting what your growth plans are going to be in the coming quarters and years?
The interest rates definitely have, the interesting thing about it is the low interest rates and the sort of easy money in the last 3 years fueled the supply boom. Now what's happening is the reverse is happening. The cost of capital has gone up so high for developers that development starts have fallen. The last numbers that came out, they fell 53% from a year ago. And most folks believe that we're going to go to post financial crisis lows on new construction. So to put those numbers in perspective, we're building 500,000 units per year annually. That number is probably going to drop next year to a little over 200,000 units. And when you look at housing supply generally, both single family and multifamily, there's a real shortage of affordable housing in America. So when you stop the pipeline like it's been stopped, you're going to have a really interesting market. What's going to happen is you're going to have a stabilization of rents in this low 1% growth kind of area, which is good for CPI, good for the Fed, good for long-term interest rates. But what's going to happen in 2026, 27, and 28, you're going to have we have a soft landing, and you end up with still a strong economic scenario that happens in those out years. You're going to have outsized rent growth again, and we're going to be back to significant rent growth because there's not going to be enough supply for the demand that is needed just to fill household formation.
Well, right now there is. We don't want to talk about immigration. People get so upset at me, and I don't want to talk about immigration either. And we're going to, first of all, what's up, Jared? Where you been, man? We miss you, Jared. We'll have to do another clap. So he made a good point. So going back to those original homeowners that purchased prior to quantitative tightening, where I was like, if they can't rent cheaper, what Jared is saying, that may be true, but they could take their proceeds and put those in the T-bills to offset the higher rent. And that's a good point. That's a good point. And we didn't have these high T-bills, right? We didn't have these T-bill yields back in the GFC. At least I don't remember. Of course, I had lost everything, so I wasn't paying attention to that type of stuff. Let me do a couple comments here that were really, oh my gosh, I got some super chats. Adam, Travelers Partner Up. I love what you stand for. Email me, brother. Maybe I'll get you on the channel and we'll do a collab and you could tell us what's going on in your market. All right. Thank you for the support as well, brother. Thank you, Travis, as well. Did you see Zillow's new TV ad titled Homeowner Mates? What is this? It'll make you sick. They'll make you sick. They want you to buy a house as a group now to combat. Okay, man. Like, instead of waiting and increasing your purchasing power and finding a great deal, just YOLO, right? You only live once. Have that fear of missing out. Is that really how? Is that where we've come to, guys? Is that sad to you? All right. Let's see where some other comments here. Here's my worry. Here's what investors really try to intimidate people with. A lot of people are going to do this. Just don't burn through all of your reserves as a down payment. Now, you shouldn't, okay? Because if you're renting and you're burning your reserves and it's 50% more expensive to own, what makes you think you can own? It's more expensive than renting. So if you can't even handle business as a renter, you guys see my point here? And so, rebudget in the front end of a recession. Rebudget, save your money, stack your money. I'm T-billing it. I'm putting all my spending on my credit card. I have a Wells Fargo active cash. I get 2% back. I pay the whole thing off. I'm using the inflation to help me. But the people that don't care, the inflation is killing them. I'm using the inflation to try to stay ahead of it. Other people are keeping their heads in the sand and they're letting inflation wreck them. That doesn't have to be you. This is the biggest concern I have right here is people give up hope. They start spending like crazy and they just took all the money that they saved to buy a house and they spent it. This is Johnny basically saying we have a Discord. I brought this comment up because Johnny, you're still in the doghouse. Do not comment. You are in the doghouse until your website is up. He helped sponsor the forum. I can't even show you guys the cool stuff that my boy Johnny has. He's got like some cool stuff, hats and all kinds of stuff. Johnny, no, you're in the doghouse. You're in the doghouse. Okay. Just wanted to call you out. Another question here. First time home buyer. This is a good one. So remember, it's very, very market specific. I don't know what market you're in. If I knew what market you're in, I would have a better understanding of the dynamics in that market. Like, are you in Maryland? Or are you in Austin? But here's their question. A lot of people feel this way. First time home buyer here. I have 100,000. That's a lot of money to put down, but I'm afraid. I will lose it all in a crash. Now, remember the 10-year rule. The 10-year rule is generally if you can hold for 10 years, you will get if the market crashes after 10 years, hypothetically, you will get your $100,000 back. So there is a premise that you don't lose the money unless you have to sell or you have to move. And my combat to that is ain't no one planned for unemployment. Ain't no one planned for death, divorce, medical, ain't no one planned for that. And even if you plan for that, how can you? So they're afraid. So understand you have a right to be afraid, right? I don't even know your market. And they're also afraid on the same side, on that same pendulum swing, they're also afraid that housing prices are going to go up even more if they don't buy now. So this is a person that has, on one hand, a fear of like losing money, and on the other hand, a fear of missing out. On one hand, this fear keeps their money in their bank account, saving, stacking. This other fear has them pay $100,000, locking themselves into a high mortgage payment. I don't know enough about you to say whether or not it's a good idea, but I will say overall, I think 99% of people should not even look at houses right now. I think overall, we need to see what's going to happen next. And I hear, the buyers are going to come running back in, blah, 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 blah. They're not going to lower rates substantially unless they have to stimulate the economy. What does that mean? Unemployment. And here's the thing. On the other side of the coin, I have this. If I find a deal, I'll buy it tomorrow. In fact, I may make an offer after this recording. And people are like, what are you talking about? Why did you make an offer? It's going to crash. You're lying. No, I'm not. I told you guys, like, what is a crash? It's buying a house at a good deal, a great deal. That's what a crash is. And that's obviously a systemic crash would have government interventions. I get that. But The other thing is this: if you can find a home that is at maybe 2020 value, 2021 value, it cash flows, it has a lot of wedge, so you can like make it through there, and you'll make it through a hard time, and you have the right expectations. If you say, not that I can hold for a year, I don't want you to say, yeah, I can hold for a year. I want you to say, I can be trapped for a year. Don't say hold. Hold is like some patriotic, yeah, let's go. Let's hold, right? Like Braveheart, let's hold. No, you're trapped. It's different. It's not hold, it's trapped. You are trapped. You ain't holding, it's holding you. It's holding you captive. You guys get it? So if you want to be locked into the house, go ahead and buy, man. That's it. And also, I don't know how much rent you're paying. If you're paying a lot less in rent, it's a little risky. So I would say wedge, cash flow, right expectations. You got 6 months saved, no consumer debt. You got that wedge, you got that cash flow. You're prepared to stay locked in. Then then maybe it's a little bit safer to buy. But I will tell you, those deals are very hard to find. Okay, and odds are that's not what you're looking at. But if you do find that under those situations and circumstances, it's going to be safer for you to buy. But also, the other thing is learn to be happy renting. Because if you're renting, but you're not losing your purchasing power like the rest of America, we're increasing our purchasing power, then it does make sense. But it is so hard for me to tell you what you should and shouldn't do, because I know nothing about you and every market, and I know nothing about your market. Every market is so unique. But what I will say, is use that subdivision analysis form and answer your own question. Okay? I really appreciate you commenting. Travis, we own 2 rentals in Elk Grove. Market is hot. Now, I brought this comment up to remind you, and that kind of ties into that last comment. The market right now, there's no blanket statement that we can make except that things are unaffordable and overpriced from a factual, historical standpoint. We can't make any other blanket statements. I can't say right now that the housing market's crashing, because the San Antonio, what am I talking about? Anaheim, West Palm Beach, right? There are still places that have rebounded and are still going up. So I can't make a blanket statement. And then also, people can't just say that the market is just going up in price, because Austin, San Antonio, Houston, I could pull up stuff right now and show you. Myrtle Beach, the Carolinas, Birmingham, Jackson, Mississippi, I could keep going. But the thing is, it doesn't matter. You only live in one spot, right? You only live in one spot. What matters is what is going on in your market. And I brought this up here to acknowledge some markets are fire, and Elk Grove is in mid to Northern California. Thank you for sharing your intel. We get 5% of our rent back. Now, this is what I want to learn how to do. I don't know how to do this. Remember, I told you guys I get 2% back as cash. I don't know how to pay my landlord with my credit card. How do I pay my landlord with my credit card? Because that's a lot of, I would get back not a lot, actually. I am a little disappointed now that I've done the math in my head. I give like $60, right? Is that right? 2% of say $2,400. That's about what, $48? Is that right, guys? But either way, who cares? It's still $48. If you don't want $48, just go ahead and tip me right there. If you don't want $48, and I'll take that $48, because trust me, I got children and I need that. I need every penny I can get, but not at the expense of taking advantage of people, right? Not at that expense. But if you could tell us, maybe email me, Mostly Peaceful, email me and tell me how exactly you're paying your rent with your credit card. Jeff, brother, I don't know if you should spend, are you going to do the work yourself? So here's the thing. So you know how I listed my house to sell. I didn't have any interest. And shockingly, we found, as we were trying to sell our house, we found another tenant. So another tenant that has phenomenal credit. I'm like, what? So when we want to sell our house, now we get the great tenant. The thing is, Jeff, we did the new garage floor by hand, and it only cost like $100. So where's this $16,000 coming from? I don't know, man. I mean, like, just remember, you guys, if you guys put money into your house from an investment standpoint, like a speculation standpoint, you got to be careful, because you will usually never get dollar for dollar. Some sweat equity you will. So like, my response to someone like Jeff, dude, we're in the front end of a recession, but if you have money saved left over, like if you spend 16 grand, but you still got 16 grand, all right, go to do what you want. It's your house. Love your house, brother, but from an investment standpoint, is that wise? I don't know the condition, but I will caution you, brother, don't be going broke. And this man loves to be a homeowner. Right here, the guy that you're looking at on the screen waited for decades to be a homeowner. And he found a home he purchased in 2023, the beginning of 2023, probably around March or April in 2023. I know that because I was on the phone with him. I was talking to him. I was like, please don't, Jeff. He's like, no, but it's my childhood dream. I'm like, I can't fight that, right? Like, you know, I love you, Jeff. I love you. I don't know if you should spend that money. I'm just being honest. I don't know if you should. We're going to go into our recession stuff here in a minute. I can't stop. I really love talking to you guys. Oh my gosh, I got another. Is this another super chat? You know, this is, bro, I didn't know that was you, bro. No, I didn't know that was you. Dude, I can't keep up with name changes. I didn't know that was you, bro. Okay, this is my man, dude. This is my man, Austin, right here. If you guys watched the abandoned video in Austin, this is my dude right here. This is Austin. Dang, you got two. Oh my God, look at this guns he's got. Austin's such a cool dude. Love you, Austin. We're going to go into our recession and liquidity now. Okay, this is a long live, guys. I'm sorry about that. I'm really looking forward to talking to you guys more, but we're going to go here. Should we do it like this? I think so. So recession and liquidity indicators, starting with the 10 and the 2 inversion. We have been inverted. Now, remember, we first inverted April 1st of 2022. So that means we started inversion from the first point of inversion. We've been over 2 years of inverted. And what's shocking to me, guys, is we have been stuck here. We are stuck here in this like lack of equilibrium. Is the market going to crash, or is the government going to keep propping it up? Well, they propped it up. Now they can't spend the money. There's money everywhere. They have so much money in the system, they can't even spend it. To put this in, that is real. That is going on right now. That is preventing things from resetting. There's so much money still. Now, this isn't creating a recession, but this is an indicator, one of the top indicators actually, of an incoming recession, which brings unemployment. So that is stuck. Also, what's stuck, there's so much money in this. The reverse repo market. This is the suspension system of the economy. This is like there's like too much money. The banks put this money in the overnight and they get, I think, a 5.25% back on that annualized. So you guys, I'm just showing you, man, like the rates aren't high enough. The rates aren't high enough right now. They are for you and I, but the rich are still like, the rich are still killing us, man. The rich are still spending. This money has stopped going down. Shocking. We're now sitting at $410 billion in the reverse repo market. Take a look at M2. You guys, I have more bad news. M2 has also been going up. I just want to acknowledge that. What does that mean? That's the money supply. What's creating the inflation? The money supply. We haven't even paid for the COVID inflation. We haven't even got out of the COVID inflation, guys. And now we have this second round of inflation. That's not good. That is killing the consumer. And let me ask you guys a question before I move on. Roughly how much of GDP is consumer spending? I want someone to comment below, please. How much of GDP roughly is consumer spending? So, and I'm saying that because that means that the spending of the consumer is super duper important to maintain this clown show, this circus. If we stop paying for it, we're okay. 70 about. There we go. So depending on the info you're looking at, it's 70 to 78% of GDP is consumer spending. You guys said 60. We got a 60. We got a 75. So it's about 70 to 78. Last info I read was 78. So consumer spending is important. But what I'm trying to say is the consumer spending is slowing down significantly, but the money supply is increasing, which is very, very bad for what we're trying to do. And not only that, the Treasury General Account, obviously we just collected taxes. April, right? We got a whole bunch of money, but I'm pointing out right here that they got a lot of money to spend, guys. They got $787 billion to spend just sitting right there. So this is scary. National deficit shifted. They got their tax revenue. So this went down to only $855 billion only. Let me show you guys again. Remember that guy was like, yeah, 2023 was great. 2023 is great. But look at, in 2023, the deficit spending was 1.7 trillion in 2023. Okay, see, 1.7 trillion. And that was up from 2022, not down. At the peak of the GFC, this is not adjusted for inflation. At the peak of the GFC, the deficit spending was 1.42. So from a nominal standpoint, we have spent more money in 2023 than at the peak of the great financial crisis. What a strong economy, wouldn't you say? And the economy is so strong, you guys, that a growing number of Americans are maxed out now on their credit cards, with Gen Z leading the way. If you're a kid, if you're a Gen Z, I'm going to tell you guys right now, you got to take action. Without action, you're wasting your time listening to me. There's a two-part piece to this. I'll point you in the direction of the mountain to climb, but you still got to climb it. If you're not climbing it, you're going to be swept in the wind. And we see it here. The younger you are, the more susceptible you are to being taken advantage of from this entire system. And all you got to do is just not be a part of it. Stop buying things. But look at this. Let me read some bullet points here. Nearly 1/5. Dang it. Okay, this is trying to get me to sign up, and I don't want to sign up. Nearly 1/5 of credit card borrowers were using 1/5 of credit card borrowers were using 90% of their credit line. Remember, you never want to go over 30%. It's called utilization ratio. 1/5 of people are at 90% utilization ratio. That's nutso. The average card carries an interest rate of 21.6%. Credit card debt is the worst, other than the illegal debt, but is one of the worst debts you can ever be in. If you want to make the banks rich, if you want to help Keynesian economics, if you want this to be the new normal, then just keep spending your credit card. That's all you need to do. If you want this to be the new normal, spend on your credit card. If you want to get out of the rat race, use your credit card to make you money, like I do. I use my credit card only to get points. And instead of cash, I'm using credit for the points. But I'm paying I have a 0 utilization ratio because I pay the whole thing off. Okay. Yeah, let's see. Is that it? Okay, so that's it for right there. Let's see what else I have for you. Excess savings. This is crazy. We're done. The consumer, remember, 70 to 78% of GDP is consumer spending. We're out of excess savings. Remember, we hit 2.1 trillion. Remember, because the Fed deposited the stimulus into the consumer's checking account. And a lot of people that's why it's so sticky. Well, that money is gone, ladies and gentlemen. We're actually down now $72 billion. So we're $72 billion down from where we were at in excess savings. That means that people are absolutely broke. We're going to listen to one more video. This video is going to be from an expert that's basically going to try to convince you to purchase in Florida because the housing market is completely fine, even in places that are collapsing. Specifically, it's more so collapsing in Florida in the areas that got hit by the hurricanes. Insurance goes up, property, all these things go up. Obviously, the mold houses. Good morning, AJ. It's nice to see you. And Nikki, there you are. All right, let's listen to this last video, and then we're going to round this bad boy out. This guy right here. This guy's a joke.
More bad news for the housing market. Mortgage rates jump back up again. 7.22%. That's where we are now. Housing guy Mitch Rochelle is with us. Can the housing market truly recover if mortgage rates stay above that level, 720?
Well, the problem, Stuart, is the definition of recovery, because I'm not completely convinced that the market is in trouble. If you're a realtor and there's less homes on the market and you're making less money because you're selling less homes, you're in trouble. If you're a home buyer, prices have steadily, creeped up. They're continuing to creep up. So I think it's hard for home buyers, but the market for people who actually own homes isn't that bad. There is a knock-on effect to the economy, though, because if people aren't buying homes, then people aren't buying furniture. They're not buying home improvement. Then there's certainly a trickle-down effect when the housing market slows. But values are still there.
But it's the politics of this, isn't it? I mean, first-time home buyers, young home buyers, they really are priced out of the market. I mean, it's very difficult for them to get in. The American dream, home ownership, that is fading for so many people. And there's a political point to be made there. That's Biden's constituency, and they're priced out of the market. It's a negative for Biden, isn't it?
Right. I completely agree with you. And you look at that younger cohort who are, starting to come into their own, maybe starting families, getting promotions in their jobs, doing sort of all the right things, and yet they can't buy a home. That's why there's this massive market out there for people who actually rent homes as opposed to apartments, because people want to feel like they're in a home, have a backyard, have a barbecue grill, have a picket fence, have a car in a garage, but they can't afford to buy them because the prices are too high and mortgage rates are too high.
Quite a situation here. I want you to address this one too. A new study shows or finds that homes in South Florida are overvalued by 35%. Okay, I don't know what they base this study on, but that's what they're saying. South Florida, Naples, Miami, that kind of thing, overpriced 35%. Mitch, that sounds like a bubble to me. Is it a bubble?
No, it's not a bubble. Here's what's interesting about that study. What they did was they went back, and I like Florida Atlantic University. It's our local school down here. But the fact of the matter is they looked at historical trends, and relative to longer term historical trends, prices are higher. However, the trend that they forgot to look at is the population trend. The population in Florida has been booming for the last 5 years. It accelerated greatly sort of through COVID, and it's continuing to accelerate. It's growing at a rate of 1.6% a year. So that's adding, considerable number of people, 300,000 plus people to the state of Florida. And as it relates to housing, we're only building about 110,000, 120,000 new homes a year in the state of Florida. So if there are more people moving here than we're building new homes, guess what? There's no bubble. Prices are going up because of supply and demand.
7.22 is where we are now.
Well, you know
housing
what?
Guy Mitch Rochelle is with us.
Interesting.
Can the housing market truly recover? 0.22%.
Jeez, I cannot.
More bad news for the housing market.
Playing this video, it took over my computer for a second there. Anyways, unbelievable. So he didn't want to talk about why don't we talk about income? Why don't we talk about equity run up? Why? It's okay because there's limited supply. Is that what makes it okay? I don't know, man. It just so many red flags when they can't acknowledge facts, right? Like historical facts. It pushes me away even more. Now, appreciate you, JT. Sold last May and moved to Tennessee, renting since. No debt, excellent credit. Been thinking of buying land and building. Any thoughts on this? I think it's romantic to think that. I think it's romantic. Like if I get land and I can build a custom house, I would probably try to do that. Understand though, by doing that, it is very much so more risky, and it is generally more difficult to get financing because there's more restriction when you purchase land to build on. There's escrow draws and things of that nature. And also a big concern, because I've thought about this as well a lot, is the builder. We have way more reports now where builders are going bankrupt and bailing out on people. And so you really got to choose the right builder. So if you could choose the right builder, they can build it for a price that's not like market, right? Like what people are trying to sell houses for. I think it could be a good way to actually build and own a house that already has wedge. Before all of this craziness happened, a lot of times if you built a house, you would also walk into wedge, because then you could build a house for less than what you could sell it for. The replacement cost was less than the market cost. Fast forward to today. I don't know, man. It depends if you're in Texas, San Antonio, in these areas that we have more of a buyer's market where we can kind of bully a little bit the seller, then maybe. But if you're like in other areas like San Diego, maybe, and I don't know enough about your market, but if it's me, I'm being very, very cautious on the financing and also the builder. If I'm going to decide to do that, I'm having a full understanding of how that loan works. Some of it is a one-time close, some of it is a two-time close, but I am understanding how to draw from escrow and what my requirements are as a homeowner. A lot of times in those loans, they give you a certain amount of time to meet certain milestones. So like you have to pour your foundation by this time. You have to have your roof by this time, hypothetically. It's risky. It is risky. So just keep that in mind. Thank you for the support, JT. Couple more comments I want to throw up here real quick. I only use my credit card to fix up my investments when needed. You have to pay it off at the end of the month. That's not 100% true. That's why I brought this comment up. Each credit card, not each credit card, but most credit cards have a different billing date. Always remember, it is the billing date that's king. I'm not talking about your due date, okay? I'm talking about your billing date. The reason why your billing date is king is because remember, your billing date is what is reported to the bureaus. And that is why I try to pay my credit card down before the billing date. And that billing date may be the 5th or the 10th or the 15th. my point is you have to read on your credit card statement when the billing date is. And if you want to play the utilization ratio game and manipulate your credit like you should, you got to pay that sucker down before it bills, just depending on your strategy. Okay. Increasing my limit to encourage me to spend. Okay. So the reason I hear you on that, but the reason I'm bringing this up is because you are a smart consumer and you can bully them back if you know how they're playing the game. If you know how they're playing the game, you use the same game they're playing against them. Okay. And now here's the thing. If you want to impact your utilization ratio, one of the ways to drop your utilization ratio without paying down the debt, say you're broke. Okay. First of all, I don't, if you have bad spending habits, you shouldn't increase your balance on credit card because you're just going to dig yourself into a bigger hole. But one way to get the utilization ratio down, instead of paying it down, you increase your limit, right? Because if you increase your limit, it will drop your utilization ratio. That's why I put that up there. I really appreciate it. You guys had some great comments today. All right, you guys, happy Friday. Let's see here. No. Oh my gosh, you guys, did you see the damage in Houston? Dude, look at the damage on 99 and what was it, West Street? I can't, man, there was like over 100-mile-an-hour winds yesterday. Downtown Houston, over 100 miles. You guys look at some of these pictures. That's crap. There's buildings with windows busted out, glass all over the streets. There's power lines just toppled. I think right now close to 1 million people don't have power. Can you believe that? Finally, like my section of Houston has power. We're usually the first to go. I have power. There's another 1 million people around me that don't have power right now. It's crazy. And I'm sure that's going to increase insurance as well. But I mean, the weather is wild, you guys. So anyways, I appreciate you guys. Happy Friday. Thank you for all of the support. Look out for this evening's drop. I have some absolute bangers coming out, you guys. I have done like 4 or 5 collaborations the last 2 days with some really good people. So I'm looking forward to that. Other than that, guys, go love some people, love your life. Maybe you wake up and do some exercise. That helps me. I don't know if it'll help you. Probably will. But if you're out there investing in real estate, you guys already know that I wish you luck. I appreciate your support from the bottom of my heart. I'm nearing 100,000 subscribers. I don't even know whether or not to celebrate that. I never thought it was possible for me to hit 100,000. So I'm still like, how do I talk about that? But anyways, guys, I hope you win.